Hi, Julian. It's nice to see you. Well, since we last spoke, the Fed has finally cut rates, with markets expecting additional cuts in the months ahead. So we have a couple questions around this topic. The first of which is not about your economic prediction, but what do you think is priced into equity and fixed income markets in terms of economic outlook?
Yes, the Fed decided to cut interest rates by half a percentage point 10 days ago. The first cut since the pandemic, and also signaled more cuts will follow. More importantly, Chairman Powell stated that the Fed will do everything it can to support a strong labor market. Equities reacted positively with both the S&P 500 and NASDAQ reaching all-time high in the past few days. So with the market cheering on the Fed, it's important to understand what is implied by current asset prices. And when looking at equity valuation, the S&P 500 today is trading at 26 times last 12 months earning, which is the top decile in terms of valuation over the past 30 years. On the same metric, every single sector in the S&P trades above its long-term average. The market also expects earnings to keep growing another 15% in 2025. When I look at corporate credit, spreads for both high yield and investment grade are at their lowest level since the Great Financial Crisis. Finally, when you look at the fixed income market, medium-term inflation expectations remain very well anchored. So it seems to me that expectations of a successful soft landing are fully priced in, which leaves the market potentially vulnerable to disappointment if economic growth slows down, if inflation spikes back up, or if we see any geopolitical flare-up. There is little margin of safety in today's asset prices.
That's a great point. Well, quickly switching to fundamentals, what types of companies do you think could benefit from a cutting cycle? And is this already baked into their valuations?
There are a few areas that will likely be impacted by the Fed easing cycle. The most obvious one is interest rate sensitive sectors. That's real estate or utilities, but also technology or biotech, which have back-end revenues and cash flows. Another important area to think about is currencies. A strong dollar has been a tailwind for US equities over the past decade. Today, the Fed is cutting rates while other central banks are increasing theirs, like the Bank of Japan. That could mean a weaker US dollar. That's why selectively diversifying portfolios with international stocks is important. A weaker US dollar and falling real yield should also be positive for gold. Finally, I want to mention real assets in general. In an environment where growth is starting to slow down, where inflation runs higher than usual, real assets, real estate, energy, materials, mining, have historically performed well. Those long-duration, asset-intensive businesses are cheap today. They offer attractive yield and might become more relevant in portfolios dominated by capital-light tech companies.
Absolutely. Well, thank you for your time, and we'll talk to you soon.
Thanks, Christina.